Melicia Gothrow, don't make this harder than it needs to be.
I'm not making anything hard.
This is Melicia Gothrow, the founder of an accounting firm in Palm Harbor, Florida. Once is a mistake, twice is suspicious. She allegedly did this hundreds of times over 4 years and left a wire transfer record for every single one.
Hard. I just want to know what this
$890,000
is.
you've been wiring out of your clients' accounts over the last 4 years.
No, that's not what happened.
6 wire transfers across 48 months, totaling
6 federal
I can
counts.
explain every single.
$894,274.26. 4 years of allegedly siphoning money out of accounts she had been legally authorized to sign on. By the time agents from the Federal Bureau of Investigation walked into her Palm Harbor office, prosecutors say they had already traced every wire, every transfer, every signature, back to the woman in this footage, and every dollar led to the same set of accounts, hers. Before we go any further, I have to ask you something. Have you ever handed another human being the legal authority to sign on your bank accounts? A bookkeeper, an accountant, a financial advisor, a family member running your bills while you traveled for work? Drop a comment and tell me what level of access they actually had, because by the end of this story, you are going to want to log in and check. And if you have not subscribed yet, now is the time. We cover the kind of white-collar cases that local news quietly buries on page 6 every single week. Melicia Gothrow was born in the mid-1970s in the brackish water suburbs east of New Orleans. The Gothrow name is older than the state of Louisiana itself, Cajun, French, traceable through parish records back to the bayous of St. Bernard and the cotton trading docks of the Mississippi River. Her father was a journeyman bookkeeper for a Slidell-based shipping company that moved grain barges between New Orleans and the Gulf. Her mother taught 4th grade at a parochial school off Pontchartrain Drive. The family lived in a 3-bedroom ranch home with a carport, a satsuma tree in the front yard, and a wall calendar from the local farmer's insurance branch hanging next to the kitchen phone. The household was a numbers household. Her father did the family books at the dining table on Sunday nights, a green-shaded banker's lamp pulled close, a stack of carbon paper receipts under his left hand, and a 10-key adding machine under his right. Melicia, by the age of 7, was allowed to punch the totals. By 10, she was reconciling the church collection envelopes her mother brought home in a manila folder. The smell of carbon paper and the specific clack of the 10-key would later be the thing she said she missed most about Louisiana after the family moved. The move to Florida came when she was 14. The shipping company her father worked for went under during a wave of consolidation in the early 90s, and a cousin in the Tampa Bay area had a line on a payroll clerk job at a citrus packing house in Plant City. The family rented a stucco house in Largo with a screened-in lanai and a Bermuda grass lawn that Melicia's father insisted on cutting every Saturday, even in August. She enrolled at Largo High her sophomore year, where a guidance counselor noted on her file that she was, quote, polite and exceptionally organized, with strong aptitude in mathematics and a tendency to take on responsibility beyond what was asked. She graduated in the middle of her class, declined the recruiters from the smaller in-state schools, and enrolled at St. Petersburg College on a partial scholarship. Associates in accounting, 2 years, with night classes she paid for by working the front counter at a dry cleaner on Ulmerton Road. Her first formal accounting job was at the age of 21, a small CPA firm in Clearwater, 3 partners, 12 employees, a strip mall office above a state farm agency. She was hired as a payroll clerk at $22,500 a year. Her duties, per the offer letter, maintain client payroll schedules, process quarterly 941 filings, reconcile petty cash, and provide administrative support to the partners during tax season. Within 18 months, she had been moved off payroll and onto small business bookkeeping. Within 3 years, she had taken and passed the CPA exam on her second attempt. The Clearwater firm raised her salary to $41,000 and added the words staff accountant to her business cards. A performance review from that period described her as, quote, detail-oriented, reliable, and demonstrating strong client relationship instincts, particularly with clients who require a higher degree of hand-holding through their personal finances. She met her husband, a Clearwater-based commercial insurance broker named Daniel, at a Chamber of Commerce mixer in 2002. They were married in 2004 in a small ceremony on a Bel Air beach, attended by both sets of parents and 42 guests. They bought their first house, a 1980s two-bedroom in Dunedin, in 2005, with a 30-year mortgage and a Bermuda grass lawn that Melicia, by then, was the one cutting. The pivot came in 2008. The recession was eating small firms alive. 2 of the 3 partners at the Clearwater firm where Melicia worked retired within 9 months of each other, and the third was actively negotiating to sell the book of business to a larger Tampa outfit. Melicia, by then a senior staff accountant making $68,000 a year and managing relationships with 17 small business clients of her own, did the math at her kitchen table on a Sunday night, the way her father had done his books, and decided she was going to leave before the sale closed and take her best clients with her. In March of 2009, she filed articles of organization with the Florida Department of State for a new limited liability company. The name on the filing was Accounting Resources and Management Services, LLC. The principal address was a one-room office in a Palm Harbor strip mall between a UPS store and a nail salon, with a window-fronted suite that rented for $1,100 a month. The managing member, founder, and president of the firm, per the filing, was Melicia Gothrow. To understand what prosecutors say happened next, you have to understand the business model. A small accounting and bookkeeping firm serving high-net-worth individuals is not the same animal as a regional CPA shop doing 1040s for retirees during tax season. The work is closer to outsourced personal finance. The clients are people whose income is complex enough: multiple LLCs, royalty streams, performance contracts, real estate holdings, endorsement deals, retirement vehicles in 3 different states, that handling the day-to-day money becomes a part-time job all by itself. And these are people who do not have a part-time job. They have a primary one that produces the income in the first place, and they would prefer to spend their time producing it rather than reconciling the books that track it. So they outsource. They hire someone like Melicia Gothrow. The arrangement, in practice, is a quiet one. The client signs a small stack of paperwork at the firm's office: engagement letter, authorization to communicate with the client's bank, power of attorney for tax matters, and, in most cases, a signatory authority form for the client's operating bank account or accounts. That last one is the operative document. It is filed directly with the bank. Once on file, it gives the named representative, in this case, Gothrow, the legal authority to sign checks drawn on the account, to initiate wire transfers, to authorize ACH debits, and to move money out of the account without the client's per-transaction approval. This is not, by itself, a suspicious arrangement. It exists for a reason. A traveling professional cannot stop a tour to call a bank and authorize a payroll run. A high-net-worth individual living between a primary residence in one state and a second home in another cannot personally sign every property tax check and every utility bill. The signatory authority form is the standard, legal, ordinary mechanism by which the work gets done. It is, on its own, a piece of paper that solves a logistics problem. It is also, prosecutors will say, the exact piece of paper that hands a dishonest accountant the keys to the building. The trust framework is binary. Either the outsourced bookkeeper is, in fact, only signing checks the client would have signed themselves. Payroll, vendors, taxes, household expenses, the predictable monthly run, or they are not. There is no middle ground. There is no audit in the ordinary case that runs in real time. The client, by definition, hired the bookkeeper because the client does not want to be the one looking at the bank statements, so the bookkeeper looks at them. And the bookkeeper, in most cases, is the one who pulls the statements down, reconciles them, and presents the client with a clean monthly summary. That summary is the entire reporting layer between the account and the account holder. If the person preparing the summary is also the person moving the money, the system has, by design, a single point of failure. It depends completely on the honesty of the person at the desk. For most clients, that is fine. The overwhelming majority of small bookkeeping firms run for decades without a problem. The accountant signs the payroll, files the quarterly reports, reconciles the household budget, and the client gets a binder at year-end and a check written out to the IRS in April. Nobody steals. But every now and then, prosecutors say somebody does. The indictment, returned by a federal grand jury in the Middle District of Florida on May 12, 2026, lays out a window. Between 2017 and 2021, 4 years, a single client, identified in the filings only as a public figure, residing in the Middle District, and a calculated total, to the penny, of $894,274.26. The client, prosecutors say, hired accounting resources and management services to manage the financial side of their professional and personal life. The exact bundle of services is not specified in the public filings, but the indictment is clear on one element. Gothrow had signatory authority on the client's financial accounts. That signatory authority, prosecutors allege, was the mechanism. It was also, prosecutors say, the weapon. Prosecutors allege that Gothrow used her access to sign documents on her client's behalf and divert funds. The mechanics, as laid out in the indictment, are quiet and procedural. She had the legal authority to sign. She used it. And the funds, prosecutors say, moved without the client's knowledge or consent, out of accounts that bore the client's name, and into accounts that did not. The first transaction in the charged window occurred in 2017. The indictment does not specify the amount or the date in the publicly available reporting, but the structure is what prosecutors are now describing in court filings. Each of the 6 wire fraud counts corresponds, illustratively, to a specific interstate wire transfer alleged to have been initiated by Gothrow from one of the client's accounts to an account she controlled. The wires themselves are the documentary backbone of the case. Each one carries a date, a sending institution, a receiving institution, an amount, a reference line, and a digital fingerprint that, once entered into the federal banking system, does not go away. Prosecutors say the pattern escalated. A 4-year window suggests that the first transactions were small enough to be absorbed into the noise of an ordinary high-net-worth client's monthly cash flow. Salaries paid, vendor invoices cleared, travel expenses reimbursed, property tax checks written. In an account with 7-figure annual throughput, a 4-figure wire that says administrative fee or professional services on the reference line does not, on its face, look like anything. It looks like an accounting firm doing what an accounting firm was hired to do. That is, prosecutors will argue at trial, the entire point. The wires were not designed to stand out. They were designed to blend into the ledger of a busy person whose ledger was, by design, being managed by someone else. The indictment indicates the dollar amounts grew. The forfeiture figure, that precise $894,274.26, is described in the filing as proceeds traceable to the charged criminal conduct. Federal forfeiture figures are not estimates. They are the product of agents sitting at a workstation and adding up specific transfers tied to specific accounts on specific dates until they have a total they can defend to a federal judge. The 26 cents at the end of that number is the tell. It means somebody traced every wire down to the rounding error in a foreign exchange conversion and put the whole thing on a spreadsheet. The lifestyle, in the meantime, was the lifestyle of a successful Palm Harbor small business owner. She and her husband had upgraded from the Dunedin starter home to a 4-bedroom waterfront on a saltwater canal off the Anclote River, a 19-foot Boston whaler tied to a private dock, a leased SUV in the driveway, annual trips to a rented condo in Highlands, North Carolina, every August, a standing reservation at a restaurant on the Pinellas waterfront on Friday nights. None of that, on its own, raised any flags. The principal of a successful boutique accounting firm in the Tampa Bay area could, by the legitimate billings the firm produced, plausibly afford every one of those things. The question prosecutors will put to a jury is not whether the lifestyle was visible, it is whether the lifestyle was funded, and whether beneath the layer of legitimate billings and ordinary professional fees, a 4-year-long second income stream was running underneath, one that, according to the indictment, had a name on it, a name that did not belong to her. The public reporting does not specify what triggered the unraveling. That is itself notable. In a federal indictment of this size, the catalyst is often the loudest thing in the room: an internal audit, a whistleblower, a new tax preparer noticing a phantom expense, a bank fraud department flagging a wire. In this case, the indictment is silent on the trigger. The Federal Bureau of Investigation conducted the investigation. The U.S. Attorney's Office for the Middle District of Florida brought the charges. Assistant U.S. Attorney Marilyn Honemeyer is the prosecutor of record. U.S. Attorney Greg Kehoe is the official who announced the case. None of those public statements identify the witness, the document, or the moment that first sent the case to a federal agent's desk. What the indictment does provide is the shape of the trigger, indirectly by what it includes. The forfeiture figure is to the penny. That means somebody at some point sat down with bank statements covering at least 4 years of activity on at least one client account and reconciled every transaction. Reconciled it, in fact, against a second set of records, the records of the accounts where the funds landed. Federal forfeiture math does not happen accidentally. It happens because somebody put the question on the table, where did the money go? And then somebody else answered it. In cases like this, structurally, the most common catalyst is a transition. A new accountant hired to take over the books. A new financial advisor brought in for a holistic review. A new business manager onboarded by the celebrity client after a contract renegotiation. A tax preparer noticing that the prior year's books, when run through a clean reconciliation, do not match the bank's records of the prior year's transfers. Or a family member, a spouse, an adult child, a sibling acting as power of attorney, taking a closer look at a parent's accounts after a health event or a probate question. Whatever the specific catalyst was in this case, The operational reality is the same. At some point in 2021, 2022, or 2023, prosecutors say, a question was asked that had not been asked before. And once it was asked, somebody started pulling statements. When the FBI does a financial fraud investigation of this size, the work is not glamorous. It is paper. It is subpoenas served on banks. It is account-to-account tracing through the automated clearinghouse and the Fedwire system. It is matching the timing of outbound transfers from a client's accounts to the timing of inbound deposits in accounts beneficially owned by a target. It is interviewing the bank officers who processed the wires, the bookkeepers who reconciled the statements, the tax preparers who filed the returns. It is in the end a spreadsheet. Prosecutors say that spreadsheet exists, and the bottom line cell, the one that gives the forfeiture figure its specific value, is the moment, in writing, when the case became prosecutable. The indictment was returned to a sealed grand jury proceeding on May 12, 2026. It was unsealed shortly thereafter. By the time the public learned the name on the cover page, the investigation, by the available reporting, had already been running for some time. The FBI's work in a case like this is built on 3 legs. The first leg is the wires themselves. Federal wire fraud, charged under Title 18 of the United States Code, Section 1343, requires the government to prove that the defendant used an interstate wire communication to execute or further a scheme to defraud. Each wire is a separate count. Each count, on conviction, carries up to 20 years in federal prison. The 6 counts named in the indictment correspond illustratively to 6 specific interstate transfers. Each one is documented. Each one carries an originating institution, a beneficiary institution, an amount, and a date. The second leg is the signatory authority. The form itself, the single page of paper that named Melicia Gothrow as an authorized signatory on the client's accounts, is in a paradoxical way both her defense and the government's strongest piece of evidence. Her likely argument at trial, through counsel, will be that the signatures on the contested wires were authorized, that the client knew, or should have known, what was being signed and what was being moved. The government's argument, conversely, is that the authority was granted for a specific purpose, to manage the client's books on the client's behalf, and that the defendant exceeded that authority by signing in her own interest, on her own behalf, without the client's knowledge or consent. The federal indictment language is explicit on that point. She was able to remove the funds without their knowledge or consent. The third leg is the trace. Money laundering is, in the federal context, almost entirely a documentary crime. The money does not vanish. It moves, and every step of every move leaves a record, an ACH ID, a Fedwire confirmation, a teller stamp, a check image, a deposit slip, a debit memo, a beneficiary line on a routing instruction. The work of the trace is taking those records and stitching them together until the pattern is undeniable. In this case, prosecutors say the pattern was. The indictment alleges that between 2017 and 2021, more than $890,000 was diverted from the client's accounts to accounts controlled by Gothrow. The forfeiture allegation, that 26-cent tail on the dollar figure, confirms that the trace is account-specific. The government is not estimating. The government is pointing at a list of transfers. The identity of the victim has been a separate story. In the indictment itself, the victim is described only as a public figure residing in the Middle District of Florida. The name is not stated. That is not unusual in federal filings. Victims of fraud, particularly high-profile ones, are routinely shielded from the four corners of the indictment to protect their privacy and to limit collateral attention during the trial process. But Gothrow's professional reach during the relevant period included one client whose name was almost too large to keep out of the press. Multiple media outlets, including TMZ, reported that Gothrow performed bookkeeping work for the professional wrestler Hulk Hogan during the same period that the indictment now covers. TMZ, which broke much of that reporting, has specifically reported that the public figure named as the victim in the indictment is not Hogan, who died in July 2025. The brief, the indictment itself, and the available court filings do not identify who the victim is. The brief does not name them. The U.S. Attorney's Office has not named them. The case proceeds, for the moment, with the victim's identity protected, and with the dollar figure standing in for the name. We are about to head into the part of this story where the federal indictment lands. Before we do, if you have made it this far, you already know this channel is different. We do not skip the parts that other channels gloss over. We do not pretend the pre-trial phase does not matter. Subscribe if you have not already and turn on the bell. The verdict in this one is still ahead of us, and when it comes, you are going to want to be here for it. The indictment was returned on May 12, 2026. It was the product of a grand jury proceeding that, by the nature of federal practice, Melicia Gothrow was not present for and was not entitled to attend. The grand jury voted to indict on the basis of the government's evidence as presented by Assistant U.S. Attorney Marilyn Honemeyer, the prosecutor of record. The vote was recorded under seal. The indictment was then filed in the U.S. District Court for the Middle District of Florida, and the sealing order was lifted on the same day the announcement was made by U.S. Attorney Greg Kehoe. By the time Gothrow learned her name was on a federal charging document, the case had been built. The wires had been traced. The forfeiture math had been done. The 6 counts had been drafted. The bond conditions had been pre-negotiated through her defense counsel. The arraignment date had been set. There is no public dash cam or body cam footage from the moment of the surrender, because the matter was not handled as a tactical arrest. White-collar cases of this kind, where the defendant is represented by counsel and not a flight risk, are routinely handled by voluntary surrender to the U.S. Marshals at the federal courthouse in Tampa on the day of arraignment. The defendant arrives in business attire, with their attorney, at a designated entrance. Processing happens in a back office. Fingerprints are taken. A photograph is taken. The defendant is then walked into the courtroom and stands before a U.S. magistrate judge to enter a plea. In open court on the arraignment date, the deputy clerk read the charges into the record. 6 counts of wire fraud, 18 U.S.C., Section 1343. The magistrate judge asked the defendant whether she understood the charges. The defendant, through counsel, responded that she did. The magistrate judge asked how she wished to plead. The plea entered on the public record was not guilty. That plea is not a denial of the underlying conduct. It is a procedural posture. In federal criminal practice, a not guilty plea is the standard entry at arraignment. It preserves the defendant's constitutional right to a jury trial and to require the government to prove every element of every count beyond a reasonable doubt. Defendants who later plead guilty pursuant to a plea agreement almost always enter a not guilty plea at arraignment first. Defendants who go to trial enter a not guilty plea at arraignment and never change it. The plea at this stage tells you, by itself, very little. The magistrate judge set conditions of release. The case was set for status conference. Discovery was ordered to begin. Defense counsel was directed to file any motions to compel, motions to suppress, or motions to dismiss within the deadlines set by the local rules. And Melicia Gothrow walked out of the federal courthouse in Tampa as a defendant in an active federal criminal case. This is where the script of a typical federal fraud case usually ends, with the sentencing, the prison facility, the release date, the restitution check. This case is not there yet. As of the latest filings, the matter remains pre-trial. No plea agreement has been entered. No verdict has been returned. No sentencing has been scheduled. 6 counts of wire fraud remain pending. Each one, if proven beyond a reasonable doubt at trial, carries a statutory maximum of 20 years in federal prison. The aggregate statutory exposure, on paper, is 120 years. The federal sentencing guidelines, in practice, would calculate a far narrower range, driven primarily by the loss amount, the number of victims, the defendant's role, her criminal history category, and whether she accepts responsibility before trial. A defense-aligned read of the guidelines on a single victim loss of just under $900,000 would land somewhere in the federal range that produces a sentence measured in years, not decades. A government-aligned read factoring in abuse of position of trust under USSG Section 3B1, 3, would push higher. The forfeiture allegation is separate from the sentence. The $894,274.26 the government is seeking to recover is not a fine. It is an in rem claim against specific traceable property, the proceeds of the alleged offense, wherever they currently reside, and any substitute assets in the defendant's name if the original proceeds have been dissipated. Forfeiture, in federal practice, is the mechanism by which the government takes back the money. It runs on its own track, parallel to the criminal case, and it follows the money regardless of where the criminal case lands. The firm itself, Accounting Resources and Management Services, LLC, remains, as of the indictment, an active Florida limited liability company. Whether it continues to operate, whether clients have moved their books elsewhere in the wake of the charges, and whether the firm survives the trial as a going concern, are commercial questions that the federal indictment does not, by itself, answer. In practice, in cases of this kind, the answer tends to be no. A boutique accounting firm whose entire value proposition is the personal trust of the principal does not survive a federal wire fraud indictment of the principal. The clients, in nearly every case, leave. What happens next, in court, runs on a federal calendar. A scheduling order will set deadlines. Discovery materials will move between the government and the defense. Bank records, account opening documents, signatory authority forms, wire transfer confirmations, ACH logs, witness statements, expert reports. Motions will be filed. The defense may move to suppress evidence, to dismiss counts, to sever counts, to compel additional discovery. The government will respond. The court will rule. The case will move toward a trial date or, far more commonly in federal white-collar practice, toward a plea negotiation. The vast majority of federal criminal cases end in plea agreements. The published statistics, year over year, have hovered around 95%. The reasons are mechanical. Federal trials are expensive. The evidence in wire fraud cases is documentary and difficult to dispute. The acceptance of responsibility reduction under the sentencing guidelines is substantial. And a defendant who has reviewed the discovery and seen the government spreadsheet, the one that produced the 26-cent forfeiture figure, frequently concludes that the path with the lowest sentence is the path that does not run through a jury. Whether Melicia Gothrow's case follows that statistical pattern or breaks from it is, at the time of this recording, not known. There are two things that can be said with certainty today. The first is that an indictment is a formal charge, not a finding of guilt. Every defendant in the federal system is presumed innocent unless and until the government proves the charges beyond a reasonable doubt to the unanimous satisfaction of a federal jury, or until the defendant herself, in open court, enters a knowing and voluntary plea of guilty under oath. Until one of those things happens, the charges in this case remain allegations. The trial process is the mechanism designed to test them. The second is that the case sits squarely at the intersection of two structural realities that produce, again and again, exactly this kind of fraud. The first is a public figure with a financial life complex enough to require outsourcing the books. The second is a small firm whose entire business depends on being trusted with the very levers it has been hired to operate. A signatory authority form is, in practice, a single piece of paper that converts a hired vendor into the legal equivalent of the account holder. And once that piece of paper is on file, the only thing standing between the account and the accountant is the accountant's own conscience. Prosecutors in the Middle District of Florida are now alleging, in a 6-count federal indictment, that for 4 years that line was crossed, $894,274.26, moved, the government says, by a single hand, across the desk of a single firm, from the accounts of a single client, into the accounts of the woman who held the signature. Whether 12 jurors will agree, whether a plea will close the case before they get the chance, and whether a federal judge will ultimately sign a sentencing order in this matter. Those are all questions that belong to a calendar that has not yet been written. For now, the case waits. The accounts wait, and the woman who built her firm in a strip mall between a UPS store and a nail salon waits in Palm Harbor for the next federal docket entry to land. This case is still being written, but the case on the right-hand side of your screen, that one already has an ending, and it is one you are not going to forget.